Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thank you very much for joining me today for this video. I wanted to provide an update on what we're doing to manage our client investments. Obviously, the markets have been volatile. And one of the things that we've noticed over the last several months is clients coming in for their annual planning meeting or other planning meetings. What we've noticed, they've really have appreciated just the reminders on what we're doing to manage their investments and also some updates that we shared with them. So I'll be doing that in our video today. All right, so let's jump into things. So again, the topics we're going to review is number one, what we're doing to manage our clients' investments. Number two, how the markets have fared over various domestic and global crises that have occurred. And lastly, we're also going to talk about how we're managing risks and leveraging opportunities for our clients. All right, so let's start first with what we're doing to manage our client investments. So overall, I would just say it's a strict adherence to a fundamental and disciplined investing process. I think that's really paramount. We obviously describe our investment philosophy when we begin working with a new client and explain how we take that academic and evidence-based approach. And I really think it could be summed up really well by an interview that Warren Buffett did in 2022. And I'll quote him, but he basically said, you know, I invest in stocks, bonds, and real estate, and that's it. He doesn't invest in Bitcoin, precious metals, new age funds, or any other fad. And that's what Fidato Wealth does, is we focus on that evidence-based approach to investing. We use managers that are looking at the size of the company, the price of that stock, their profitability, and other factors. And they're making just sound decisions based upon fundamentals. And the evidence shows us over the long term that that produces a reliable result. And that's really the key, especially in times like today. I also want to talk about what our institutional managers are doing on a daily basis. So we do use institutional managers, and they're managing the stocks and the stock funds or the bonds and the bond funds. Now, on a daily basis, they're monitoring the holdings and they're making adjustments. So one example that I can share with you is the bond managers that we're utilizing. There was a period of time where short-term bonds were paying more interest than intermediate term bonds or longer term bonds. So in the portfolio, they shifted to short-term, high credit quality bonds. And it was a pretty dramatic shift, but they're watching what bonds are paying. So that's very important to note. They do the same thing on the stock side of the portfolio as well. So there's a lot that they do on a daily basis. They have campuses of analysts globally, and they're monitoring the holdings. One of the other things to note is just the institutional manager performance. So we do obviously do ongoing due diligence of the different managers that we're utilizing. And one example that I'll share with you is the small cap fund that we use in our portfolio. It's an institutional manager. And over the past year, and this is as of February 28th of 2023, over the past year, the fund is down negative 0.54%. Now that's before our fee, but that fund is down negative 0.54%. Vanguard's small cap index fund during that same period of time is down negative 4.5%. So you can see here, the fund is doing better by a total of 4% over the past year. Now, why is that? The fund is not just an index fund. It's looking deeper. It's looking at the size of the small size company. You know, there's different sizes within small cap. They're looking at the price of the stock. They're looking at the profitability of that company. So they're looking at fundamental data to try to get a better result than just an index fund. And the institutional managers that we utilize, they have a long-term track record of doing that. So, really in times like this, institutional manager performance is really helpful and key to not just taking just a passive approach. So the other thing I want to share with you is just the bright side of bonds. Now, we all know, you've heard me say this before, that bonds 97% of the time will move in a random direction compared to US stocks, right? The purpose of bonds is to have that diversification, so that way when stocks are not doing well, bonds are. Well, 2022 was one of those years that fell into that 3% area where bonds also dropped in value. But what is the bright side? The bright side is the interest being paid on these bonds is gone up. So that's very important to note. And some of these, the interest it's very attractive. So that is going to help, right? Because that interest is being reinvested back into the bond fund typically, which you're going to acquire more shares, right? Obviously the interest rates have gone up. So that's very important. And the other thing that I want to share with you is that how just really everything ties back to the capital markets. And so what I mean by that, for example, you can get a CD at a bank that might pay 3 to 4% now. Well, how does that bank earn interest on your funds, right? They don't have any magic pixie dust that they can sprinkle over the cash to have it grow by that interest rate. They actually have to take that money and also invest it in the capital markets. Now, they also do make money because they lend out money, mortgages, car loans, things like that. But they also do things like buy US treasuries, buy short-term debt instruments. So they have to take that money and put it in the capital markets to get a return. Well, that's what the bond funds that our clients own. Some of the bond funds will buy treasuries or short-term debt instruments, or high credit quality bonds, which is typically what a bank will do to generate, right, cash to pay that interest, right? Everything always ties back to the capital markets. So while interest rates on bonds have gone, interest rates on CDs have gone up, so haven't interest rates on bonds, right? And so what we see successful people do is invest directly into the capital markets. Another thing that's really important is just having a portfolio of uncorrelated assets, meaning that your asset allocation is critical. And with our clients, we've obviously managed their asset allocation. And the best way I can sum this up is a quote from Ray Dalio, who ran the largest hedge fund in the world. And he said, there is no perfect investment. It's about having a portfolio that is diversified, and that when some assets are down, others are up or neutral. So, and that really brings us to the design and intentionality of our portfolios. That is absolutely critical and has been key to manage the downside risk. And lastly, I think, and this really ties back to another Warren Buffett video that I listened to, and actually his annual letter came out to their shareholders just recently. But Warren Buffett always says he will never bet against the American economy over the long run, over the long term. He believes in the American economy, and I think that's important as an investor to maintain that outlook, that over the long run, the American economy will prevail. One of the things that Warren Buffett talks about is how if the economy grows 2 to 3% per year, what that means over a 5, 10, 15-year period. It's significant. So another thing that he described in his video that I thought was really, I think, interesting and positive and true is he talked about the improvement in the quality of his lifestyle. And he's in his 90s now, right? But when he was born, what homes were like then, what cars were like then, technology probably wasn't really in existence that much then. And just how the standard of living has increased during that time period. He actually said that people living today live better than likely how Andrew Carnegie grew up, because times were different, despite all the wealth the Carnegie family had. All right. I also want to just emphasize how markets have rewarded discipline. So this shows you the growth of stocks from 1970 through 2021. You can see here in this green line, it is an upwards trend. But I want to share all the different crises that have occurred during this period of time. There was an oil embargo. The S&P fell 43%. Inflation was 13.5%. Business Week, the newspaper, or the magazine publication, published on the front page. It was called "The Death of Equities." Boy, were they wrong. There was Black Monday, savings and loan crisis. Iraq invaded Kuwait. Income taxes went up. There was a Russian financial crisis. There was the Y2K scare, right? Everything was going to end at 2000, right? Everything was going to, kind of shut down. We had the .com stock market crash. We had 9/11, hurricanes, the Iraq war. You guys kind of get the point here. There's been all sorts of stuff that have happened, and markets prevail. You can see that clearly on this chart. And just remember, good news doesn't sell. The media is focused on fear and greed and leveraging those emotions to gain viewers. Okay, I think that's really important to understand. All right. The last thing I want to share with you is just how the longer you invest, I apologize. Actually, there's another slide. Imagine that, another graphic I want to show you. But here, this is showing you the longer you invest, the lower the risk of you losing money. Okay, so this is very important. And we work with a lot of clients that have been disciplined investors for decades, and they don't flinch when the going gets tough. They stay the course, and that's really important. And that's what our clients have done as well. So, but if you look at the return of stocks from 1926 to 2019, this looks at different rolling periods, but you can see here, the longer that you're invested, the lower the risk of losing money. That's something I've seen as well by looking at client accounts. The longer they're invested, you can see if somebody's been invested for 15 or more years, there's only a 0.2% chance that you will lose money. It gets to about 90% after year 5 and continues to climb. So really, this gets back to avoiding at all costs anything associated with the phrase, "this time it will be different." And listen, I understand the economy, is showing some resiliency in certain areas, and there's a lot of uncertainty. So I get all that. Dalbar is an organization that does a study, and they look at how investors perform compared to the markets. Okay, so this is looking at from 1992 through the end of 2021, the average investor on their own earned 7%, but the overall markets went up a little over 10.5%. So unfortunately, the average investor out there that manages their investments, unfortunately, they tend to buy high and sell low. And we obviously want to do the exact opposite for our clients. Look at this on a dollar basis. An average equity investor during that 30-year period would have grown to about $800,000 versus $2 million if they just would have stayed invested. So this is really, really hopefully helpful data for you. But it's very important, right? You can't, as you guys know, you can't time the markets. The best days in the market often occur real close to once the worst days occurred. All right, so let's talk about how we're managing risks and opportunities. So number one is just how the portfolios, again, are constructed. Within the bond sleeve of the portfolio, we have an investment that invests in short-term debt instruments, where it maintains the value of $1. And the only thing that fluctuates is the amount of interest, right? And again, interest has gone up. Um, we also use short-term bonds in the portfolio. As you guys know, we only use investment grade bonds. There are no junk bonds, no high yield bonds in the portfolio. And most importantly, not only how the portfolio is constructed, but then how the managers manage the bonds. So it was, really great to see. Now, I was not surprised at all, but it was just great to see our institutional managers in action as they shifted the bond holdings from more of a intermediate term basis to short-term bonds, high credit quality, because those were paying the most interest, right? They're not going to keep our clients invested in a longer term maturity bond, because the longer the term, the more risk, when they can earn more interest in a shorter term bond with higher credit quality. As you guys know too, we also manage our clients' retirement income distributions. We manage their distributions for them. We're very selective on selling assets that are up the most or perhaps neutral, leaving other assets alone to fund distributions. So what we're referring to there is actually dollar cost averaging out of your portfolio. We also have clients that are dollar cost averaging in, where we're going to look to buy the assets that have decreased the most, right? Again, we want to sell high and we want to buy low, the opposite of what a retail investor does. So those are just two examples of rebalancing. Obviously, the diversification, the asset allocation, and the institutional management are paramount. And most importantly, it's having a comprehensive plan and continuing to do things to further your wealth plan that adds value down to your bottom line, and relying upon that plan. So I'm referring to there again, planning, but also opportunistic planning, keeping our eyes open on opportunity. And really controlling what you can control is very important. And sticking to your plan does not equal doing nothing. So you guys have, this is not new information, but I'll just recap it. But there's a lot of things that we do when there's volatility. We look at, does our client have debt that can be restructured? Is there tax planning? Is there any investing that a client was planning on doing? If so, what can we be purchased, right? That could be purchased that maybe is down more in the portfolio. It's important to note actually here that 401k limits have been raised for 2023. So if you haven't adjusted your contribution, for those of you working, contributions to your 401k for 2023, you'll want to do so. Also sometimes it might make more sense to contribute to a Roth versus an IRA versus non-qualified. Again, if you're planning to make a contribution, obviously you can't time the bottom, you can't time the top, but with that volatility, it's a great thing to take advantage of it. One of the things that we help our clients with is them determining if they have any investments that have a tax loss. The planning of retiring is also important, making sure that you do have a comprehensive plan before you retire is absolutely critical, right? With that comprehensive plan that includes investments, financial planning, and wealth management, that is really what's needed to be able to handle volatility with confidence. The timing of major purchases is also really important. And just really making sure that you're taking advantage of all available opportunities. All right, so in conclusion, you guys, there's been other videos I've recently put out and where I've talked about where I don't think that this is just a short-term patch in the economy, that we could have a period of a year or so where the economy is challenged. There is more volatility. So I do believe that there could be a longer road ahead of us. Markets have rebounded a little bit, right, since the beginning of the year, which is great. Also, remember that the capital markets are a forward-looking indicator, meaning that when the markets close that day, it's not based upon the actual profitability of the companies that day. It's based upon what investors think those profits will be in the future. So sometimes we could be in a recession, clearly in a recession, and markets begin to shoot upwards. Again, that is because markets are a forward-looking indicator. Important to keep the long term in mind. Fall back on the evidence. Turn off the news a bit. Everyone is, media is vying for everyone's attention. And lastly, just take opportunistic actions that are in your best interest. So I hope you enjoyed the video today. I do recognize that times are challenging. There's a lot of uncertainties, but at the same time, there are a lot of certainties and a lot of evidence to fall back on. And one of my favorite quotes that I adhere to is that there's nothing new under the sun. We've been through this before. We're going to help our clients through this phase, and hopefully this video helped. Again, there's a lot that our institutional managers are doing and that we're doing to navigate the current economic conditions. Thanks so much. Have a great day, and we wish you the best. Take care.